welcome to another episode. My name's Jose Najarro, and today we're going to continue to look at GoPro. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company is doing. So let's begin. The first thing we're going to look at is the income statement, right? In the income statement, first we're going to start off by looking at revenue. Here in revenue, the first thing I can see, right, is there is a downtrend in revenue. That does seem like it is still happening. Even though last quarter, previous quarter, they provided $292 million of revenue, compared to same time last year was 282, and same time the year before that was 296. So this company does seem to be around its normal range for quarter two. Just with revenue, you also see the cost of revenue decreasing. So, right, and that's something you would expect. Cost of revenue would be lower if this company is doing less revenue. Next, we're going to take a look at gross profit, and gross profit does seem to be improving a teeny tiny bit compared to previous quarters, especially if we took a look at same times last quarter. This quarter is sitting at $102 million of gross profit. Same time last year was $83 million, and same time the year before that was $105 million. So right, it is doing better. We can see it did provide revenue better than same time last year, and the gross profit is obviously better than same time last year. And it's actually not that far off from 2017, where this company was collecting a higher revenue. So the first point I'm going to end up giving is to Bull Solo, right? We do see this nice gross profit here. The company is still providing at least some positive gross margins. Next, we're going to take a look at net income, which is the one that truly matters. And here in net income, we can see this company has a negative $11 million of net income. So this company is actually burning cash. So obviously we're going to give a point to Darth Bear for that. We don't want to invest in a company that's burning cash at all. But the good thing is $11 million is definitely a lot better than it has. And we can see, right, there is an uptrend going on with net income. There was a time in 2016 where this company was burning about $115 million. The next thing I'm going to take a look at is operating income, earnings before interest and taxes, and net income. And the reason here, I just want to take a look at the graphs themselves. I just want to see that all the graphs match. Here, all these are just different incomes after different expenses. But at the end of the day, they should still maintain the similar visual matter of them. If they don't, then that to me tells me that there's something happening within those expenses. But we can see here, if we take a look at all three, operating income, earnings before interest and taxes, and net income, they look identical. So for that, I'm going to say there's no funky business going on in the company. So for that, that's going to be another point to Bull Solo. So next, we're going to take a look at my favorite financial document sheet, and that is the balance sheet. Here in the balance sheet, we're going to start off with total assets and total liabilities. We can see that this company's total assets has been decreasing, but its total liabilities, even though it's been increasing, does not seem to be increasing at a rapid pace. So that's pretty good. Right now, this company is sitting at about $500 million of liabilities with $698 million of total assets. So this company still has a positive shareholder equity of about $200 million. Here, I'm debating on who I should give a point to, because here in Darth Bear's point, we are seeing this downtrend of shareholder equity, right? Just 3-4 years ago, this company had about $830 million of shareholder equity. Now it's sitting at about $200 million. So we are seeing that downtrend of shareholder equity. But then in Bull Solo's type of point, he might argue that, right, we are pretty flatlined. We flatlined on shareholder equity in about a year ago in March of 2018. And ever since there, this downtrend seems to have stopped and is now flatlined. I'm actually, now that I think about it, I'm going to end up giving the point right now to Darth Bear because I still don't see an uptrend happening. Even though it has flatlined, this can go either direction. So Darth Bear, I think, has a better grasp of this part in the shareholder equity. Next, but it is pretty good, right? I mean, in Bull Solo's point, it is pretty cool that it is flatlining, and it has flatlined for the past 1, 2, 3, 4, 5, 6. I want to say for the past 6 quarters, it has maintained at least around within this range. Next, we're going to take a look at the asset distribution and the liability distribution. The first thing I want to take a look at is liability distribution. Um, so the first thing we can see is about $208 million of this company's liability is non-current debt. And if we saw a look in the last episode, about $175 million of that is some security notes that are due 2022 with the 3.75 interest rates at $175 million. That's very low interest at such a long time from now. And the rest are most likely operating expenses, operating leases, and all liability coming from that. We see another huge portion comes from payables. Payables is sitting at about $115 million, and current debt is sitting at about $9.2 million. And this company does have a small deferred revenue, but that again, deferred revenue to me, I consider it fake revenue, a fake liability, because eventually we're going to end up seeing that in the asset distribution once it hands over the items it needs to. But first, let's take a look at that payables. So payables is sitting at $114 million. And I like to compare payables to receivables. Receivables this quarter is $144 million. So that to me, I can cancel out that asset and that liability because receivables is higher than payables. So to me, that payables is nothing. The only thing we really have to worry about in this company is this non-current debt at $208 million. But if we take a look, this company has cash and cash equivalents of $91 million. It has current investments of about $40 million. So that's about $130 million in quick inventory. So that tells me that this company definitely can survive a long time. Not a long time. It can definitely survive. It is a healthy company, and it seems like a very stability in debt. There's no real. I don't think at the moment there's any strong debt that can truly hold this company down. So for that, I'm definitely gonna give a point to Bull Solo based on the liability distribution. Let's take a look at the asset distribution. Here in the asset distribution, let's see how things are going. Intangibles seems to keep lowering its thing, but that's what you expect to happen there. Let me just take out some of these stuff. So let's just look at first let's just look at the asset distribution as a whole. Right now, this company is sitting at about $144 million of receivables, like I mentioned, about $140 million of some form, more like $130 million of cash and cash equivalents or any liquidized items. It has about $100 million in property, plants, and equipment, about $130 million in inventory, and $155 million in intangibles. Intangibles for me are truly fake assets, and that's not one that I consider a real asset. So I'm gonna ignore. I don't like how it's a huge portion. It's sitting at about 25% of the company's total asset. But overall, the asset distribution is pretty good. It is broken down. There's no actual piece holding it together. I did expect property and plant equipment to be a lot higher than this, but I'm glad it's not. This company does have a high amount of inventory, and that's the only thing that worries me. I mean, 20% of the company's total asset is inventory, but again, nothing to really get me pretty antsy or scared about anything. Let's just take a look at inventory. So here we can see inventory. It's kind of dropping, right, compared to previous years. It is sitting within a range. That's definitely a good thing. Let's take away inventory and let's look at maybe current investments. Current investments have also been dropping, but it has increased. Non-current investments, they does not have one. Cash and cash equivalents. This company is reducing its cash and cash equivalents. But if you looked at the last episode, we did notice that they are expected to have a cash and cash equivalents of about $200 million by the end of quarter 4 of 2019. So that's pretty good. So the asset distribution, I don't think it's strong for Bull Solo or it's strong for Darth Bear. So I'm not going to give a point to either of them. So they can both cry right now because no one's a winner. Next, we're going to take a look at net cash flow from operations. Here in the cash flow statement, the net cash flow from operations should show that this company is making money from its everyday operations. But unfortunately, it does not seem to be the case. It's right now has a negative $1 million of cash flow. At least this company is not burning money, but it's not positive. So obviously, I'm going to have to give a point to Darth Bear on this one. Next, what I want to do, if you guys remember, I took a look at all the incomes and make sure that the graphs look pretty much the same to make sure there's no manipulations going on. Well, the same could be done with net cash flow from operations. I tend to look at that for here. If we take a look at net cash from operations and compare it to revenue, we can see that these charts look pretty much the same, except one has a lower axis than the other. It's just been shifted down a little bit. So that to me tells me, right, if revenue is trending, you want to see net cash flow from operations trending that way. And that's exactly what's happening. So that's good news from here. And next, we're going to check earnings per basic share and compare it to net cash flow for operations. And again, even though they are pretty jumpy here and there, they are following pretty much the same type of path. And that, again, it helps me tell me that there is no manipulations happening with the numbers. And for that reason, there's another point that here's going to go to Bull Solo. So the final place we're going to take a look at are metrics for the company. And some of these metrics, we're going to take a look at some of the metrics I tend to look at: debt to equity ratio, current ratio, gross margins, and profit margins. Let's start off with current ratio. So current ratios is current assets divided by current liabilities. Obviously, you want current assets to be higher than current liabilities, so a ratio greater than 1 is to be expected. It's always the better choice. So right now, current ratio is sitting at 1.6%. So that means this company has 1.6 more current assets than it has current liabilities. It also seems to be higher and have been within this 1 point for pretty much long time. So for that, I'm actually going to give a point to Bull Solo on this one. That to me tells me that at least this company can easily survive at least this year, another year. So that's definitely a point for Bull Solo. Next, we're going to take a look at that debt to equity ratio. And here in the debt to equity ratio, that's total debt divided by total shareholder equity. Here you want shareholder equity to be higher, so you want this ratio to be below 1. Unfortunately, that does not seem to be the case for this one. So we already know who's going to get the point on this. It's going to be Darth Bear. Right now, this company is sitting at about a 2.5 debt to equity ratio. So that means debt is about 2.5% higher than equity. So that means this company is leveraging pretty heavy. Next, we're going to take a look at gross margins. This gross margins is sitting at about 35% this quarter. Compared to the same time last quarter was 29%, and the quarter before that was 35.6%. So it's pretty much it does seem like it is on the downtrend, but 35 is still definitely a good number. It's not too far off from 2 years ago, and it's much higher than last year. So for that reason, I'm gonna give another point to Bull Solo on this gross margins. Unfortunately, we can see profit margins are on the negative, and that's why we had that negative net income. So we can see here that we're gonna end up giving a point to Darth Bear for this negative profit margins. But the great thing is it does seem like profit margins are increasing, and hopefully this company can turn it around. So now for the fun part, would I buy this company? I mean, if we took a look at the last stock, this company has currently a PE ratio, a forward PE ratio of about 9.2 based on today's current price and based on 2020's earnings per share. So a 9.2 PE ratio is actually pretty cheap compared to the overall market. But why is it cheap? I mean, this company, I definitely think it has a healthy debt liability. So this company can definitely maintain itself for the future. It does seem that it is trying to improve its margins. We can see it by its profit margins seem to have an uptrend. We're seeing definitely a nice amount of revenue going on. So this company is definitely trying to shift things around. But now let me give the best case scenario. Let's say this company shifts stuff around. Let's say it becomes profitable again. I personally can't see where this company wants to head to. So how many people can actually buy these GoPros, and how can this company make its camera go to the next level? And that's what I don't see. And that personally, me as an investor, I need to see the vision of where the company is headed. But once this company cuts down all its costs, and once this company is maintaining a profit margins again, where is it headed? And for that reason, I think even a 9.2 PE ratio is too high. And I maybe somewhere around like I mentioned in the last episode, somewhere between like a 7 or 8 PE ratio is where I would want to I would probably get into this company. And that would be somewhere around $3 and like $3, and this company had a future earnings per share of 0.43 cents. So 0.43, let's go on the high end for $8. I would purchase this at maybe $3.44. That would be where I feel like this company might be cheap enough. But at the moment, I don't think so. I mean, it might still be undervalued, but it still might be undervalued. Some investors might think it's undervalued. But for me, I don't think right now it's at the moment where I would risk capital to grow, for it to continue to grow, because I don't think I personally think it might be a little overvalued. But if it goes below that 3.5, then that to me, I would agree with the risk to reward ratio in that one, and I would definitely try to invest in GoPro. So I hope you guys enjoyed this episode. Let me know what you guys think. Let me know what you think about GoPro. Are you an investor? Are you investing in these levels? Let me know why you think this company is gonna go up. I mean, I'm here to learn. I'm not the perfect investor, right? This could be my biggest mistake, not investing in GoPro. I'm not here to tell anyone that you are wrong or that I'm right. I'm just here to show and learn, and hopefully you guys can. If you guys think this is if I'm being wrong here, feel free to let me know, and let me know why. I love to have a conversation on stock and the stock market. So make sure to let me know. Like I said, make sure you guys hit the subscribe button. I try to post videos pretty often. Give me a thumbs up and post in the comments. See you next time. Have a good night and take care.